All right, let's just dive right into it. For years, the name Alibaba was basically synonymous with one thing, right? Chinese e-commerce dominance. But today, the company you thought you knew is actually undergoing this massive, frankly, super expensive pivot to become an AI infrastructure behemoth. We've got our hands on a really fascinating and honestly pretty skeptical 2026 buy-side investment memo that literally pulls no punches. So in this explainer, we're going to strip away that legacy brand name, look purely at the numbers and the strategy, and figure out what is really going on under the hood of this tech giant.
So the absolute crucial point we're evaluating today is right here. Is Alibaba still an exceptional long-term investment? I'll just give you the bottom line right up front from the report. The short answer? No, not right now. The argument here is that transitioning from a highly profitable marketplace into a capital-heavy AI and cloud provider, well, that just completely changes the math. We're going to break down exactly why this analyst thinks Alibaba functions way better today as a risky restructuring play, rather than, a reliable cornerstone for your portfolio. Now, to understand where they are, we kind of need to see how they got here. It started with that brilliant 1999 founding by Jack Ma, which led to absolute market dominance and a massive 2014 IPO. I mean, that was their golden era. But if you look at 2020, that was a huge paradigm shift. Regulatory crackdowns, the halted Ant Group IPO, that permanently altered their trajectory and basically erased that aura of invincibility. Fast forward to 2026, and leadership is making this incredibly aggressive pivot toward artificial intelligence and cloud computing to try and claw back some of that lost momentum. Section 1, the Alibaba paradox. We're breaking down the business. When you look at their fiscal 2026 segment revenue, their current reality is, well, it's a really delicate balancing act. You can clearly see the largest slice is still the China e-commerce group. That's their mature cash cow. But notice how it's actually being used. It is heavily funding the Cloud Intelligence Group, which is their very expensive new growth engine, along with their international commerce push. And then there's that all other slice. That little bucket represents residual projects and legacy complexity, and those are operating at a pretty significant loss. So it's this incredibly delicate act of using yesterday's profits to buy tomorrow's technology. And zooming in on that e-commerce cash cow, we're seeing a really stark divergence in the March 2026 quarter. On one side, quick commerce, think instant local delivery for groceries, daily goods, that sort of thing, is just exploding. It's up 57%. But on the flip side, traditional customer management revenue, which has historically been their most profitable advertising and merchant fee segment, is totally stagnant. It's barely growing at just 1%. This perfectly illustrates a core problem they're facing: explosive growth in an area that is brutally expensive and low margin, while their incredibly profitable core business is essentially flat. Which actually brings us to a really standout quote from the memo itself. The author notes that Alibaba is no longer a clean, dominant China e-commerce platform at a cheap multiple story. And why is that? Because rivals like PDD and Douyin are just fiercely attacking their market share. Alibaba is literally being forced to spend billions on subsidies and rapid delivery just to defend its turf. The days of easily collecting a toll on China's e-commerce traffic without a fight, those are gone. The narrative has completely, fundamentally changed. Section 2. The AI Cloud Pivot. The New Frontier. So if e-commerce is under siege, where is the hope? Well, for Alibaba's management, the ultimate savior is the cloud. And to be fair, they have some very real momentum to point to. 38%. That is their external cloud revenue growth in just the March 2026 quarter alone. And this isn't some accounting illusion. This is heavily driven by their AI-related products, which have posted triple-digit year-over-year growth for several consecutive quarters. Honestly, this is the absolute brightest spot in the entire investment memo. But we do have to temper that optimism with a heavy dose of skeptical reality. Because yes, they have incredible AI revenue momentum and undeniable market leadership in China right now. But AI infrastructure is a wildly capital-intensive arms race. We're talking massive capital expenditures, or CapEx, combined with severe chip constraints and various geopolitical hurdles. The report makes the strong case that impressive revenue growth in AI simply doesn't guarantee strong profitability, especially if literally everyone is overbuilding data centers at the exact same time. Section 3, the cash flow problem, a financial reality check. And here's where things get a bit rough. Free cash flow has taken a really sharp, frankly alarming, downward trend. In fiscal year 2025, they brought in a very healthy flow of roughly 74 billion RMB. But then look at fiscal 2026. That plunged entirely into the red, all the way down to a negative 46.6 billion RMB. Now, to be perfectly clear, overall revenue actually ticked up slightly during this time frame.
But the sheer volume of cash they had to pour into AI infrastructure, quick commerce, and just aggressively defending their market share, it completely wiped out their free cash flow.
Now, I know seeing negative cash flow like that might make you panic, but context is everything here. As of March 2026, Alibaba was sitting on 520.8 billion RMB in cash and liquid investments. So bankruptcy is absolutely not the risk here. They've got a massive war chest. The analyst's real concern isn't solvency, it's the quality of how that capital is actually being deployed. Think about it. If your cash is constantly being eaten up by defensive spending and a relentless AI capex cycle, the fundamental economics of your business are degrading over time.
Section 4. Embedded liabilities. We're looking at structural and geopolitical risks.
The memo outlines 4 pretty major hurdles for outside investors here. First, Alibaba's partnership governance structure structurally limits the power of minority shareholders. You just don't have as much say. Second, the recent addition to a U.S. military company list adds this lingering layer of geopolitical discount to the stock, regardless of the operational truth of the matter. Third, management trust took a really big hit after they announced and then very abruptly abandoned highly anticipated spinoffs of their cloud and logistics units. And lastly, the complex VIE ownership structure is just a constant baseline risk. Look, asking investors to fund a multi-billion-dollar AI transition requires immense trust, and right now, the analyst feels that trust is pretty fractured.
Section 5. The investment verdict. Let's get into the final takeaways.
At the end of the day, the stakes here are just incredibly high. The bull case requires nearly flawless execution. Their AI margins have to scale up beautifully, and their legacy commerce business has to totally stabilize against fierce competition. If they pull all that off, the stock is deeply undervalued. But here's the catch with a bear case. Alibaba doesn't even need to collapse for the bear case to happen. It simply requires the current reality to continue, meaning intense competition and sky-high AI spending keep eating away at profits. Even if the company remains a dominant tech giant, the actual outcome for a shareholder's equity would still be pretty poor. Which leads us to the ultimate conclusion drawn by the memo's author. They state, Alibaba is a good business with some exceptional assets, but it is not presently an exceptional long-term investment quality business. That is a huge distinction. At this exact moment, if you're looking for a high-confidence, steady compounder, this probably isn't it. It functions way more like a high-risk restructuring play. You really have to demand a massive margin of safety to tolerate the execution and governance risks involved here.
And all of this leaves us with one final, incredibly high-stakes question to ponder. Can massive AI investments successfully rebuild a crumbling e-commerce moat? Alibaba absolutely has the cash, the talent, and the technology to do it. But as we've seen throughout this explainer, trying to buy your way into the AI future while desperately defending your past is a remarkably expensive and deeply uncertain tightrope to walk. It's a fascinating transition for sure, and one that every single investor watching legacy tech giants should be keeping a very, very close eye on. Thanks so much for joining me on this deep dive.